Okay, now we're moving on to the good old S&P 500 and look at a similar pattern. We'll look at the daily first for a more of a slightly longer term picture, longer, I would say intermediate term picture, and then look at the 60-minute for a shorter term, quote unquote, dead cat bounce retracement type of picture. So here we are on the S&P 500. I drew the lines from the September 2014 period that fit in my screen here, and at that point we were around 16,024. So we went up 300 points roughly. Sorry, not 300 points. Yeah, we went up more than 300 points. What am I talking about? We went up about 360 points, and this is where you can see that. Okay, so now we have retraced. We have retraced from the highs of around the 1990 level down to what was the exact high on the S&P 500? Just trying to get that nailed down. 1991.39. Okay, so from that we have retraced now down here. We touched the 78.6% fib retracement level. You can see that clearly right here. The downtrend line intersects at around 1893. So we certainly have room to move down and test this line. We have had multiple retests. Get the drawing tool out. Multiple retests, once almost here. That was back in October 2014. Seems like decades ago, right? And then we had it in February. Then we had it, well, not quite. We held the Bollinger. We never came down, to test the uptrend line in April. And then we are here now. Now we have blown through the lower Bollinger. You can see that right here. This was the lower Bollinger right here. And generally speaking, when you blow through a Bollinger, you tend to reverse back into it before you fail again or whatever you want to do. All right? Now, interestingly, and I just noticed this, again, I repeat, I'm a very astute student of the market, charts, and anything that is related to the market, so I know I find things just as much as you all do, and feel free to share that with us in the forum. So that we had that the upper Bollinger is still moving up. Very odd, given the fact that we had such a pretty dramatic decline. The upper Bollinger still seems to be shooting up, but then that we're shooting up here too before we corrected. But this is a little bit odd here. I don't know why. So we have the 34. This is the dotted orange line. We have the 50 moving average here. This being the daily, and this is where we are. As you can clearly see, the stochastics are very oversold, and every time they've done that on a short-term basis, look what's happened. So I'm just doing this for everyone. 1, 2, right here, multiple retests, right here, multiple retests. Okay, I repeat again, there's nothing in the market that says it's written in stone. So be flexible, do not be uber dogmatic, and again, always have a directional bias as to what you might be thinking overall. I am still of the directional bias that this is not the start of a bear market, that this is a corrective pullback for many different reasons, as we all know. There are global crisis fears, massive institutional blowout, margin call sell-offs. I've written all that very extensively on my Twitter posts, end of the day reports. There is also fear that the Fed will panic and start raising rates, which I don't think is going to happen. We have fear that inflation is creeping up to a runaway level, which I don't think is going to happen. A slight wage inflation is not necessarily that bad. A runaway wage inflation is bad, but then you can spin it around and say, if you're going to get paid more, you're going to spend more. You're going to feel better, you're going to do it. Consumer confidence is relatively high. So again, you can spin it both ways. You can look at the dogmatic bearish side, or you can look at the bullish side, or it can be stay course in the middle and say, okay, I'm just going to play what the market gives me, but this is my directional bias. So that's it. So here we are with the S&P 500 on the daily level. So we're getting close to a tradable bounce. Whether it comes Monday or Tuesday, I have no idea. But let's watch and see what happens. Okay. And again, I repeat, this is one set of charts I'm looking at. I look at multiple charts, multiple indicators, and they're all kind of close to a deep oversold bottom on a short-term basis. Let me look at, let me take this out. Let's go back to the hourly to look at the short-term dead cat bounce routine. Let me put up the Fib retracements. When you're dealing with Java, it's not always very fast. Okay, so here we are. So what are we looking at? The Fib retracements. Let me get my drawing tool for the S&P 500, and this is what we're looking at. We have a Bollinger here, lower Bollinger, which we can slip to the 1900s, which I would kind of welcome. And that would be nice panic, another 25-point drop or so, or 20-point drop on the S&P. That's roughly about another 160 points in the Dow. All hell breaks loose. Lots of primal screams. Lots of grizzlies roaming around talking about Armageddon and the end of the world. And bang, right? That's when the market turns for a very sharp reversal, retracement rally. So that's one scenario. Second scenario, we basically, hold around here and bounce up over. This is the 23 Fib that we fell through. So we could very well, move up and test the 34 line, which also happens to be the 50 retracement, 50% fee retracement, which I've shown many, many times in stocks and also in the indices. We have a gap fill here. This was a little bit more methodical at around the 1970 level, and of course, if we capture 1970 on the S&P, the so-called standard technicians and all that stuff are going to say we reclaimed the uptrend, and all kinds of usual, typical talk is going to resurface. I'm just going to play the trade. So there is a gap around here, around the 1970 level where we fell through. This is a waterfall decline, impulse sell-off. Things that normally would take weeks happen in hours. I've said that many, many times. This is a prime example of it. Big reminder. On Tuesday evening's end of the day report, which I was delayed, but I kept on doing it. It was posted showing as 1 a.m. or so on Wednesday morning. I clearly showed the pullback levels, the possibility of a breakdown given what I was seeing on the charts. Wednesday threw me off the curve, and I'm not the only one, because the market did exactly the opposite on the Fed minutes, okay? And then Thursday, it went ballistic, and Friday, it was overall a bullish day. So when you look at the zigzags and the volatility, you can't come to me and tell me that you can predict the market on a daily basis. I base it on my experience of what I've seen, and so far my track record has been strong, and that's the only reason why you all are here. So what I'm getting at is you cannot game this market to a certainty. You have to be very fast, very flexible, yet at the same time, and this is where the difficulty lies in traders. We have to hold things because we know it's going to do a certain thing. It eventually gets there if you look at a lot of my charts. But by the time it gets there, there are so many swings and chop that a lot of traders get thrown off the boat. But the plane does arrive at the airport. It just doesn't arrive on time. So that is something that we'll have to all learn how to manage. That's why I say manage your own trades. I cannot give you a formula how to do that. Play small, be flexible, don't put all the eggs in one basket and then throw in, and then the market basically smashes the basket. Don't do that stuff. Always have cash on the side. And then of course there's an element of luck and an element of fearlessness and courage that comes with trading. That's something I can teach you. That's something you will develop. And these are the times, I believe, that traders can learn a lot and exercise mental and fiscal and monetary discipline and do what they need to do. So these are the times you need to cut your teeth in, get through the boot camp, and become a real fighting Marine, right? God bless our troops. So that's S&P 500. Let me move on to the other ones now.